In today's episode, I'll talk about three very interesting stories. In the first story, I'll talk about how the Middle East is today set up for an all out war and what this could mean for you and me as investors. In the second story, I'll talk about what China's new reforms look like in order to improve their struggling economy. And in the third story, I'll talk about how smartphones have overtaken diamonds as the largest export item from India to the US. Welcome to the Daily Brief Show by Zerodha, where our aim is to give you news in a way that is one level deeper as compared to traditional news channels. I'm your host Anurag Bansal, and today is Tuesday, the 1st of October. Recently, a huge development took place in the Middle East. Hassan Nasrallah, the leader of Hezbollah, was killed in a targeted strike by Israel. Hezbollah, if you are not familiar, is a militant group and a political party based in Lebanon, which is heavily backed by Iran. Now, the question is, why does this really matter to people like you and me? See, Nasrallah has been the face of Hezbollah for decades now. Taking him out is part of Israel's bigger strategy to weaken Iran's influence in this region. Over the past few months, Israel has ramped up its fight against Hezbollah. They have targeted and eliminated over a dozen top commanders. And this is not just a one-off event, it is a major escalation and it brings a very real risk of sparking something much bigger, especially if Iran decides to retaliate. And this is where things get really tricky for us. Look, Hezbollah is deeply connected to Iran, and any response from Iran could push the entire region closer to an all-out war. Now, this comes on top of the war between Israel and Hamas, which has already put the Middle East on the edge. So, as tensions rise even further, everyone is now asking what really happens if Iran steps in. How would that impact the rest of the world, especially global markets and oil prices? Look, if Iran gets involved directly, we are talking about a potential full-scale war across the Middle East. This would no longer remain a regional conflict, but it could pull global powers as well. The US, as some of you may already know, is Israel's very close ally. On the flip side, Iran has the backing of Russia and in some cases China as well. So if things do escalate, we are not just looking at a Middle Eastern war anymore. It could spread to other countries like Iraq, Syria, and Lebanon. And that is exactly where things could spiral out of control. But the real danger for you and me as investors is what this entire situation could potentially do to the global economy, particularly the energy markets. See, the Middle East produces about 30% of the world's oil, and if something major disrupts that supply, oil prices could absolutely skyrocket. According to Bloomberg and the World Bank, depending on how bad things get, we could be looking at a few different scenarios. First, if the conflict stays somewhat contained, we could see oil prices jump to between 93 to 102 US dollars per barrel. Second, think of something along the lines of the Iraq War of 2003. If something on those lines breaks out, oil prices could spike to 109 to 121 US dollars per barrel. Third, if we are looking at a full-scale war involving the entire region, prices could go up to as much as 157 US dollars per barrel, which is absolutely catastrophic. And it's not just oil. When oil prices go up, so does the cost of pretty much everything. We're talking about shipping, food, raw materials, you name it. So no matter what part of the world you live in, this is going to hit your wallet. But here, let me zoom out for a second and talk about how much of what we consume actually relies on global shipping routes specifically. Now, the reason it is important to discuss this is because a major conflict in the Middle East would disrupt those routes and drive up the cost of transporting pretty much everything from raw materials to finished goods. Now, this means potential shortages, higher prices, and more inflation. One key piece in all of this is the Strait of Hormuz. If you're not familiar with it, the strait is a narrow waterway that connects the Persian Gulf to the Arabian Sea. It is the main route for about 20% of the world's oil and 25% of the world's LNG or liquefied natural gas. Now, if the Strait of Hormuz gets blocked, even temporarily, oil prices could skyrocket overnight. And the reason why this is the case is because there are only a very few alternative routes for moving oil, like pipelines in Saudi Arabia and in the UAE. But the thing is, they also do not have the kind of capacity that is required to make up for a complete shutdown of the strait. So in short, there are no real alternatives that could prevent a massive disruption here. Now, this would hit Asia the hardest, especially countries like China, Japan, India, and South Korea. And the reason is that these countries are very large importers of Middle Eastern oil. Europe and US would also feel the pain a little bit, but the US has been reducing its dependence on Middle Eastern oil in the recent years. But still, no matter where you are in the world, this is very bad news. Now, you might be wondering, could Iran really close the Strait of Hormuz? Look, historically, Iran has made threats to do so in the past as well, but they've never really followed it. That is because Iran itself relies on the strait for about 90% of its own oil exports. Closing it off would hurt them just as much as anyone else, maybe even a little more. Plus, the US has a significant military presence in that region, which is specifically tasked with keeping these shipping lanes open. So, the bottom line here is that while Iran can actually cause a temporary disruption or even harass ships, a full closure of the strait will likely lead to major military response from the US. So, while it is definitely possible, it is not the most likely scenario. Now, moving on to the next story, let's talk about what is exactly going on with China's economy and why experts are calling the country's latest stimulus package a bazooka. By the way, a quick side note before I start the story, if you are interested in understanding why China exactly needs this stimulus in the first place, there is some fascinating economic history, and we have covered this in our new show called Around the World in 30 Minutes. The link is in the description below, so do check it out if you're interested. Back to the story. Recently, Chinese policymakers introduced a set of measures to boost the economy and stabilize financial markets. These include interest rate cuts, support for the struggling property sector, stock market interventions, and fiscal stimulus through bond issuances. In addition to this, the People's Bank of China is offering about 100 billion US dollars in lending to encourage stock purchases and buybacks. But the thing is, details of these measures are still very unclear and fuzzy. What we have right now, though, is only just a framework or a signal of intent rather than a detailed plan. But the question here is, why is China doing this exactly, and why should people like you and I really care? I'll explain. See, China is currently facing several big challenges. First, property sector crisis. Home prices have been falling for 4 years straight in China, and this is important because real estate makes up about 30% of China's GDP. Since the peak in 2021, home prices have dropped by 20 to 40%. And given that about 70 to 80% of China's household savings are tied in real estate, this is a massive issue for them. Second, weak consumer confidence. People are not really spending as much as they used to, and consumer confidence has hit record lows. Third, local governments are struggling with heavy debt. The IMF is estimating that China's total government debt, including local financing, will reach 110% of their GDP in 2023. Fourth, China has a slowing economic growth. Official figures put 2023's GDP growth at 5.2%, but many economists think that it was even lower, closer to 3 to 5%. Next is lower inflation and even deflation in some cases. Inflation has been so low in China that China has occasionally dipped into deflation as of late. In August 2024, inflation was just 0.6%. Now the question is, can this new stimulus package pushed by China really turn things around for them? Let me explain this problem-wise. First, let's look at the property sector. See, the real estate crisis is a structural problem that cannot be fixed overnight if you think about it. There is an oversupply of housing in many cities, and future demand will likely come from upgrades and not new construction really. But right now, people have stopped buying altogether. Second, the financial system of China. See, China's financial system, which once used to fuel its growth, has now become a constraint for them. Banks are struggling with low profitability, and credit growth has significantly slowed down, even with record low interest rates and bond yields. Third, China has a shrinking fiscal capacity. China's ability to spend its way out of its problems is very limited. Government revenues, both tax and non-tax revenues, have dropped from 22% of GDP in 2015 to just about 16% in recent years. Next is demographic decline. Since 2013, China's working age population has been shrinking significantly, and it has made it very hard for them to sustain high growth. Historically, whenever a country's workforce declines, it is very difficult to grow faster than 3% over the long term. To put things into perspective for you, back in 2008 during the global financial crisis, China launched a massive 4 trillion yuan or 580 billion US dollar stimulus package. This new package is significant but much smaller and much more targeted than the previous one. It is aimed at addressing very specific problems rather than flooding the entire economy with cash. But it does signal that China is taking things very seriously now, and we could see some more actions being announced very soon. But despite these challenges, some big investors are still optimistic. A billionaire hedge fund manager, David Tepper, recently told CNBC that he's buying everything related to China. His logic is that Chinese stocks are currently very undervalued. Many companies are trading at low PE ratios or price to earning ratios with solid growth prospects, especially as compared to higher valued US stocks. In fact, Chinese stocks have already started to see a bump. The CSI 300 index, which tracks large companies in China, had its biggest weekly gain since 2008 by the end of September 2024. But before we get too excited, let us remember, as of August 2024, the MSCI China index was trading at a forward PE ratio of just 8.9. That is very low as compared to the broader emerging markets index at 11.75% and the MSCI All Country World Index at 17.72. So while there is value in Chinese stocks for sure, it comes with significant risks. I'll also give you a fun fact here. Since its inception in 1992, the MSCI China Index has delivered a sum total return of zero. So China is a good example of how the economy and the stock market do not always move in sync. Now back to the recent stimulus, while it may boost the stock market in the short term, it is less likely to solve China's more fundamental and deep-rooted problems. Some economists believe that China's economy has already peaked as a share of the global economy. It hit a high of 18.3% of global GDP in 2021, and it has only been falling ever since then. China's long-term challenges are structural. First, China needs to move from an investment-driven economy to one led by consumer spending. But household income is just 61% of GDP, which is low by international standards. Second, China's banks need to be reformed. Many are struggling with low capital levels, and to fix the system, they need to write off bad loans and stop lending to underperforming borrowers. Third, with the shrinking working age population, it is rare for any economy to grow faster than 3% over a 5-year period, like I previously mentioned. Next, the global environment is not quite what it used to be. Many countries are now diversifying their supply chains away from China as a China plus one strategy, which is making it harder and harder for China to rely on export-driven growth. Some analysts are comparing this to Europe's Draghi movement. For context, back in 2012, Mario Draghi, the then president of the European Central Bank, very famously said that the ECB would do whatever it takes to save the euro. That speech marked a turning point for Europe. But experts do not really think China is in the same position today, and there are three reasons for it. First, in the short term, the government is clearly signaling a buy for Chinese stocks by providing support. But this is all about setting a floor for the economy, not really driving aggressive growth. Second, China's stimulus is more about preventing things from getting worse, like a doom loop of falling confidence, rather than pushing for major economic expansion. Third, the stimulus does not directly address long-term issues like demographic decline, high debt, or the need to shift from an investment-led economy to one that is powered by consumers. Now, these challenges will take more than short-term measures in order to resolve. So all in all, in summary, while China's latest measures have definitely sparked a rally in stock markets, their impact on the real economy is still very, very uncertain. The company's deeper challenges are structural, and short-term fixes may not really be enough to solve for them. For now though, we'll have to wait and see how things unfold. Moving on to the third and the final story of the day, let's talk about how smartphones have now overtaken diamonds as the largest exported item from India to the US. See, for a very long time, India was known for being the largest exporter of diamonds to the US, non-industrial diamonds to be more specific. Now, this is because India has been a global leader in the gem and jewelry market for many, many years now. But recently, something very interesting has been happening. Smartphones, which is led by Apple's iPhones, have overtaken diamonds as India's largest export to the United States. In the June quarter of FY 2025, India exported $2 billion worth of smartphones to the US, while diamond exports fell to $1.4 billion. And this is not just a one-off situation if you're thinking that way. The gap started to become visible back in December quarter of FY 2024, and it has only been growing wider and wider ever since then. Smartphone exports have surged by 43%, while diamond exports have dropped by almost 5%. But the question is, why is this exactly happening and why is there such a sudden change? Let me break it down for you by starting with diamonds. See, India's diamond industry has been an export powerhouse for quite some time now, like I already mentioned. But as of late, it has been facing some very serious challenges. In fact, the overall diamond exports from India has dropped by about 30% as compared to last year, which is massive. On top of that, the price of rough diamonds has been steadily falling for the last 18 months or so. According to Dinesh Navadia, who's the chairperson of the Indian Diamond Institute, the industry is at a breaking point. There are a few main reasons behind it which you should know about. First is the G7 ban on Russian diamonds. In December 2023, the G7 countries put sanctions on Russian diamonds. This was a big hit for India because we used to get about 30% of our rough cut diamonds from Russia itself. These sanctions also includes diamonds processed in other countries inclusive of India. So this adds compliance costs, which makes it even harder for the industry to stay competitive. Second, declining US demand. The US is India's largest diamond market, but demand there has dropped significantly now. High interest rates have caused people to spend less on luxury goods, and on top of that, lab grown diamonds are becoming more and more popular by the day, especially for things like engagement rings. So, natural diamonds are, in some sense, losing their shine in the market. Next, China's economic slowdown. China is another major player when it comes to diamond exports for India, and their economic situation, like I mentioned in the previous story, is really affecting India's diamond exports. China's demand for diamonds has dropped by nearly 30%. So, as a country like India, when two of your biggest markets are slowing down, it is quite a tough place to be in. Because of all of these issues, factories in Surat, which is at the heart of India's diamond industry, is feeling the heat. Many of them have started operating only 2 days a week now, which is a very clear sign of just how much pressure the industry is under. But while diamonds are struggling, the smartphone industry, on the other hand, especially Apple's iPhones, are absolutely booming. But the question is, what is really driving the surge in these exports right now? Look, it all comes down to a combination of global supply chain shifts and smart government policy. I'll explain. First, Apple has been working to diversify its supply chain away from China. I'm sure we've all heard about the China Plus One strategy, which is countries trying to reduce their dependence on Chinese goods and services. India is benefiting from this in a very big way. Apple has invested heavily in manufacturing in India, and India now accounts for a massive 14% of Apple's global iPhone production. This means 1 in every 7 iPhones made globally are now made in India. Now, a big reason for India's success here is the government's Production Linked Incentive or PLI scheme. This policy has been very key to attracting foreign investment and boosting local manufacturing. Thanks to the PLI scheme, Apple's export from India has hit 12.1 billion US dollars in FY 2024, and with the US and China locked in a tight trade relationship, more and more companies are looking at India as an alternative manufacturing hub. So the question is, what does all of this mean for India's economy at large? Look, for many years, India's economy has been heavily reliant on labor intensive industries like diamond cutting. But now we are seeing a shift towards high tech manufacturing, and that is no small achievement. This shift is more than just about smartphones. As the world becomes more and more dependent on technology, India is positioning itself as a very key player in high tech manufacturing. Policies like the PLI scheme are helping our country attract the kind of investment that we need in order to compete on a global level. But with this shift also comes a set of new challenges. I'll tell you what, high-tech manufacturing requires a much more skilled workforce than industries like diamond cutting. So India will need to invest heavily in workforce development to keep up with the demand for specialized skills. So India will need to invest heavily in workforce development to keep up with the demand for specialized skills. But that said, if the growth in smartphone exports is any sort of indication, India is well on its way to becoming a global manufacturing powerhouse. Now let's move on to the last section of the day, which is the small, tiny tidbit pieces of news. First, Zydus Life Sciences has received an approval from the US FDA to sell enzalutamide capsules, a prostate cancer treatment. With US sales of the drug reaching 870 million US dollars annually, this is a major step forward for the company in the US market. Second, starting October 1st, the NSE and BSE will introduce a new fee structure for equity and derivatives trading. This is following SEBI's rules to make fees the same for all traders. Third, Kalyan Jewellers promoter has raised 1,300 crore rupees from Oaktree Capital in order to buy Warburg Pincus's stake in the company. The loan is secured by 8.51 crore pledged shares and helps the promoter increase their ownership. Fourth, OpenAI's revenue has surged to 300 million US dollars a month, with annual sales expected to reach 3.7 billion US dollars. But the company faces significant losses, which is projected at 5 billion US dollars in 2023 due to its rapid growth. That's all the news and stories I have for you today. I hope you found value in today's episode. I'll see you tomorrow. Take care and goodbye. Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.